everyone, I am Master Khurana and welcome to Zerodha Varsity Videos. We are in episode 6 where we are discussing Warren Buffett's letters to his shareholders, and Satya and I are taking on this crash course where Vineet is helping us to understand these letters better. In the previous episode, we discussed the year till 2001, where we saw that there was 9/11 attack, and on top of that, we also discussed the alternate investments that Warren Buffett did, which was investing in oil and silver. Apart from that, in the year 1999, we discussed that how 1999 was one of the worst years in terms of performance for Berkshire Hathaway. This episode, we are going to discuss 5 years from year 2002 to 2006. So let's understand from Vineet that what is the agenda for this year, because mind you, 2001 was 9/11 attack. Berkshire Hathaway is an insurance company, so it gets really important to understand what is happening with the company now.
Thank you, Astha. Let me first lay out the economic scene of the time. So at this time, interest rate was coming down and the USD was depreciating against the GBP and Euro. These were basically Warren's views that were now crystallizing clearly. And also that, yes, the insurance operations was facing problems because of the 9/11 attacks. But also 2004 and 5, the US saw a lot of hurricanes, Katrina, Wilma, Sandy, etc. So they also suffered losses from there. So let me set the tone for this episode. We will of course talk about acquisitions, but around this time Warren had also started doing foreign acquisitions. Apart from that, we will see how earnings yield differs from return on equity in the invested businesses. So then yes, we'll also discuss a few of the businesses that they've invested in the years before this period. And we'll also talk about Warren's curt views on corporate governance. And of course, he's always used these letters to write stinkers for financial services providers, for investment bankers, for the boards of other companies, etc.
See, I agree with you that he keeps picking up bone with these financial analysts, bankers, etc. But I always believe that he has a justification for it and valid logic behind it.
Oh, justification and logic he did have when he picked a bone against the White House.
What did he do this time?
Yeah, I remember that. Warren Buffett has written his views in the Washington Post. It's an opinion piece. It's very interesting. So this time, the US government has made the dividends tax exempt in the hands of shareholders. Now, Warren Buffett did not like it. Mind you, he was unhappy not because he had to pay more taxes. He was unhappy because wealthy people like him don't have to pay more taxes than the ordinary people. So he explained this with an example. So Warren and his receptionist both fall under the 30% tax break. Now the receptionist is earning salary income. On the other hand, Warren, most of his income is from dividends. Now owning to his 31% share in Berkshire Hathaway, if Berkshire Hathaway announced 1 billion in terms of dividends, he would be getting 310 million in form of dividend. As I said, dividend could be, large portion of his total income. Now what happens? The tax that he had to pay, now dividend is tax exempt. Now because of which the tax that he had to pay drastically comes down when compared to his total income. So he had to pay only 3% in this example. While on the other hand, his receptionist still had to pay 30% of her total income, right? Warren is saying that his receptionist had to pay 10 times the proportion of the total income to be paid as taxes than he do. So he had a problem with this. He says that the ordinary people has to have more tax breaks that will stimulate the economy more than being the dividend income tax exempt in the hands of wealthy people. It's a different thing that Warren Buffett never announced dividends from his company.
The same thing.
Yeah.
So in fact, he's referring to this post that he's written in the Washington Post in his letter to the shareholders. And he's saying that the US tax secretary from the Bush administration, in fact, commented on Warren Buffett after he wrote this letter. She's saying that this Midwestern oracle continues to not pay any dividend taxes because he has been only making capital gains. Berkshire had never declared any dividend. So Warren was only becoming richer and was not earning any dividends. So this dividend tax break or not, it was not going to affect him anyway. Now Warren is saying it's okay if we don't make dividends and pay taxes on dividends, but we are paying almost $4 billion in taxes to the US Treasury, and we are running more than half of one day's operations there. In fact, he's giving this example. He's saying where Berkshire Hathaway accounts for 1% of the total market cap of the US companies, but is paying tax that is 2.5% of all the tax paid by the US companies.
But Vineet, what I want to understand now is that, okay, that he's picking up bone with these people. But we were talking about that how 2001 has been a very difficult year for the country and for the company because they are an insurance company. So how are their returns being, in this era?
So yes, because of these hurricanes, they had to pay out a lot of these claims, but they were not impacting their returns so much. However, their equity allocation had come down considerably. So the year 2002, 3, 4, 5, for 4 continuous years, they made mid to high single-digit returns only in their book value. It was only in the year 2006 that they finally made 18% returns. Now, why is that? Is because the asset allocation, basically, equity was only 50 to 60% of their overall investments. The size that they had become, they could not possibly hold all of it as equity. Now, if your equity is down, the rest of it is held in debt or cash equivalents. That is not going to grow at the pace of equity. So hence, your returns are going to slow down.
I like the term that you used, asset allocation. Asset allocation is investing your portfolio of money into assets based on the risk that you have and the expectation or the financial goals that you have. Now, in this case, Warren, he reduced his equity allocation. Why? For him, 2 things are priority. One, to honor the clients that he would get because they're running an insurance business. To honor the clients whenever they get any claims is the topmost priority for them. They are an insurance company. They know times are a little bleak at that point in time, and they wanted to maintain enough liquidity so that whenever there are claims, they will be able to honor them without much hassle. And he knows that equity is not for short-term financial goals, and that's why he could have reduced the equity allocation. The second important thing is he always says whenever there is bad time, we often hear in the news and various people writing about it, when market falls, it is a good time or a good buying opportunity. Right. He knows about it. So he wants to have enough cash so that whenever there is a correction in the market, he can go and deploy that money. So these are the 2 important requirements for him, or the financial goals we could say, around which he built that asset allocation. He says, no matter what, Berkshire has to be ready, even if there is any financial downturn, or even if there is stock market closure, and even if there is a bio attack or the chemical attack, whatever it is, the Berkshire Hathaway will be ready to face any of those situations because their liquidity is so high. That's why his equity allocation could be lower.
Vineet, I want to understand when Satya is talking about equity allocation, and you also said that, they have reduced the equity. So how much cash do they have now?
They have roughly $40 billion around this time, and their threshold is $20 billion. They don't want to go below $20 billion. So yes, like Satya mentioned, they want to be ready for opportunities, for emergencies, and for paying the claims that would come from their insurance operations.
That is really nice. When Satya was talking about asset allocation and how Warren Buffett's change of financial goals make him reduce the equity allocation, but of course he has, as you said, been holding a lot of cash. This also reminds me that it is a lesson for retail investors as well, because retail investors are also being told to do proper asset allocation of their portfolio so that you can meet your different requirements, and at times you have a strategy attached to it, which is goal-based investing, where you attach your particular asset to a particular goal. So the lesson here is that the way Warren Buffett has changed his goal depending upon the change in times and the change of requirements, as and when you also meet your goal, you need to go back again and kind of rebalance or redo your asset allocation journey, because that is how you will be up to mark with the market times, and that is how you can achieve better in terms of returns of whatever assets you have allocated to,
with less volatility in your portfolio.
Yes, correct.
So yes, with size, they had to do asset allocation. Now, it was not just equity and debt. We've seen that they've started investing in alternatives. There was one very exotic product that they invested in. It's called the Life Settlement Fund.
Okay, what is a life settlement fund?
Satya, why don't you take it up?
So life settlement refers to selling an existing insurance policy to a third party. Say suppose a person named X, he or she is in need of cash. There are insurance policies where you surrender the insurance policy with the insurance company. The insurance company will give the surrender value. I'm sure you would have heard of it. It's called the surrender value. Now, say suppose if the person X is surrendering the policy, insurance company is paying 100 rupees as surrender value. But there are third parties who say that, give the insurance policy to me, I will give you 120 rupees. So this person named X will surrender or give the policy to this third party. So this third party continues to hold the insurance policy. This third party will continue to pay the premium.
Okay.
And upon the death of X, this third party will receive the death benefit from the insurance company. The insurance policy is not getting terminated. It's just that the third party is becoming a beneficiary for X's death. Is this happening in India? No. As per the Insurance Act in India, a third party cannot be a beneficiary of someone's life.
Okay. That is because in India we have the insurance principle called insured interest. If you do not have an insured interest, you cannot take policy on someone else's behalf. What else do we have in his investment portfolio?
Yes. So again, one more alternative route. He's started investing in foreign currency. So initially he's investing in foreign exchange, but year or two later, around this time only, then he starts acquiring foreign companies or investing in minor stakes in foreign companies.
But my question is that why is he investing in foreign currency? Because we know that USD itself is a very strong currency.
Yes, USD is a very strong currency when we look at it as Indians, because INR has only depreciated against the USD, but USD in itself has been depreciating against Euro and GBP. Let me give you an example. So now we know that 1 USD, let's take this for an example, 1 USD equals 80 rupees.
Yeah.
What you do, you know that USD is going to appreciate against INR over the next 1 year. So you trade your 80 and take 1 USD. You invest this 1 USD in, let's say, an S&P 500. Over the next 1 year, this $1 will become 1.1.
Correct.
You were expecting INR to depreciate. So meaning, let's say 1 year later, it has gone up to 85. Now, if you try to convert this 1 USD back into INR, you're going to make 93.5. Essentially, you're making about 16-17% from your investment. Someone who is an American investing in the American markets made 10%, but as an Indian, because your currency depreciated, you made gains not only on the USD markets, but also on the USD appreciation. So you make about 16 to 17%. Warren had been saying that USD was depreciating against other currencies. He said this, we've discussed this even in the first episode. He's saying that this continued for a long time. So around this time, his views crystallized and he is investing. So he has invested in GBP and Euro. There's also a foreign acquisition that he's done. He's bought an Israeli company. It's a cutting tool manufacturer called Iskar. Again, it was a family-owned business and they wanted to simplify their generational transfer of wealth. And they came to Warren and Berkshire Hathaway gave their business a house to continue to exist with independence.
Nice. But what I want to understand is, while you were talking about foreign currency, how as Indians we can invest in foreign currency?
So there are different routes for that. First, if you want to invest directly in foreign stocks, of course there are a lot of fintech platforms that are allowing you to invest in foreign stocks directly, or you can also open an account directly with a foreign broker and you can invest in foreign stocks directly. Apart from that, you can also take a mutual fund route, where mutual funds are investing in foreign companies or foreign ETFs or foreign indexes, whatever it is. You can take that exposure. So this will not come under the LRS route, which is the liberalized remittance scheme. I'm sure that whoever wants to invest outside, they know that it has to come under LRS route. Liberalized remittance scheme, but mutual fund, if you're investing in Indian mutual funds, it is not under that. Apart from that, you also talked about Warren investing in foreign currency, right? They're taking exposure to that. In India, retail investors, people cannot invest or trade in foreign currency. That's not allowed in India. Of course, if you want to take a hedge against your investment, say suppose you want to have a higher education in the US and you are saving for that. To manage the exchange rate, you can take the hedge, but you can go to the bank and ask for the hedge and enter into the forex transactions like that, but you cannot trade in foreign currency in India.
So Vineet, you just talked about foreign currency and you mentioned about foreign investments. And since we are talking about his investments, why don't we discuss some of his acquisitions?
Sure. So one of the largest acquisitions that Berkshire Hathaway has done around this time, in fact, they did it a few years before this period of 2002 and 2006, but you'll understand why we are discussing it now. So their investment was in Mid-American Energy, and Berkshire Hathaway picks 80% stake in Mid-American Energy. However, they're not consolidating this in Berkshire's books.
Okay, wait. If I correctly remember, in the one of the previous episodes, Satya was the one who actually helped us understand that how the reporting is done into the books of the parent's company. And if you are holding more than 50% in a subsidiary company, the parent company has to report all the numbers in the consolidated form. You're saying that they were invested 80% in the business, but they are yet not reporting all of it, which means they're only reporting dividends. Why is that?
I'm so glad that you remember that. Let's refresh our memory. In this case, Mid-American Energy, yes, Warren Buffett held 80% stake, but Mid-American is also a utility company. So there were so many restrictions around these companies in this sector. So it comes under public holding, what is it? Public
PUHCA Act.
Yeah, Public Utility Holding
Company
Act, yeah. So in that case, though Warren Buffett held 80%, the voting power given to Warren Buffett and Berkshire Hathaway is only 9 to 10%. So for accounting purposes, this only 9 to 10% is considered, and everything with respect to Mid-American is not considered in Berkshire Hathaway's books. It's only one line from the balance sheet and the profit and loss account. Is just one line that is mentioned with respect to Mid-American. But he was also hoping that this PUHC Act will be repealed and he will be able to account for all the earnings of Mid-American in his books. Later it happened though.
Yes, it was in the year 2005 that they finally repealed the act. Now for Warren Buffett, it did not matter whether you consolidate the business or not, because it was the intrinsic value that mattered to him, and that was getting added to Berkshire Hathaway's value. So he's saying that this was a utility business. Why was he invested in this? We know that before this, he's only invested in mostly consumer businesses, retail businesses, or manufacturing businesses, or other insurance. But utility is something that he's getting into for the first time. Now, there are two reasons that he's explaining. One is specific to the sector, and the other specific to Mid-American Energy. So the first is utility is an essential service. Mid-American Energy supplies natural gas to people's homes by laying gas pipelines. This is an essential business. Whether there is recession or inflation or whatever, people will continue to consume gas to heat their homes or to cook. Now, so that's why this was an advantage for Mid-American Energy. And two is that they had gas pipelines in multiple states. So if there was an operational or regulatory issue in one state, the earnings at other states were going to complement and support their operations to continue. However, it was not just the utility business that Mid-American Energy was invested in, although that was the reason Warren picked stake in it. Somehow incongruously, as Warren puts it, they were also invested in a real estate brokerage firm called Home Services of America. In fact, this is the second largest real estate brokerage firm in the USA. They had 17 brokerage firms under this business, and these firms employed more than 18,000 brokers. They grossed real estate transactions of roughly $60 billion in 2004. So yes, while it was otherwise a small business, it had become really huge in overall scheme of things for Mid-American Energy.
This really looks very unlikely of Warren Buffett and very random that he is entering into a utility business, and then there's another arm which is into real estate.
Yeah, but around this time, he had also invested in other real estate business called Clayton Homes. Clayton was in two businesses. One was manufacturing homes. So basically, these homes are manufactured at the workshop, and they are transported and installed at your land. So that is one. And the other part is giving home loans. So basically, the people who are buying these homes, you give loans to them, and also to other home buyers. So buyers who are not buying home from you, but from someone else, from some other sellers.
Let me interrupt you to tell you a beautiful story behind the acquisition of Clayton Homes. Sure. We all know that, whatever the companies Berkshire Hathaway invests in, they have like great stories. We've heard great stories in the previous episodes as well, right? This is the unusual one. Warren Buffett himself calls it a very unusual one. In the US, he was popular by then. Warren Buffett was very popular by then. So every year, a group of students comes to him to take or interact with him. So usually these students, they go and eat or shop in Nebraska, Berkshire, and also, what is that restaurant name?
Goratz.
Yeah. They have lunch there. And in the evening, usually these students go and meet Warren Buffett for about 2 to 3 hours. Now, every year after the session, Warren Buffett was gifted something. Sometimes it is a football or a basketball signed by a celebrity or something like that. But in 1 year, he was gifted a book on Clayton Homes, the founder of Clayton Homes, which is Jim Clayton. So when he saw the book, he was very interested. His interest got piqued. So these students connected Warren Buffett to the son of Jim Clayton. He's called Kevin Clayton. And Warren Buffett, just because he read the book, he assessed Kevin Clayton, he wanted to buy a stake in the company. And Clayton Homes also know that a higher stake from Warren Buffett or a company like Berkshire Hathaway will give them the stability to finance or expand in the future. They agreed to sell the stake. This is how Warren Buffett, through Berkshire Hathaway, bought a stake in Clayton Homes. Interestingly, these students who helped Warren Buffett to know about Clayton Homes were given PhD certificate from Berkshire, and they were also gifted a Class B share of Berkshire Hathaway. Not just that, the professor who escorted these students, he was gifted a Class A share, which is like multiple times the value of Class B share.
This is really crazy, and I wish I was part of those kids group. I would have been happy with the Class B shares as well. But this investment is really random for Warren Buffett. I don't know what is more random, Mid-American Energy's home services or this. These interesting stories is the one which keeps me alive with these boring businesses. So we need, with every acquisitions or every investment that we talk, we always discuss insurance business. So what is new in insurance?
Well, there's another interesting story for their boring insurance operations, Astha. So this is not an acquisition, but they are taking on all the liabilities of Equitas, which is an insurance company.
Okay.
However, let's go back to the origins of insurance as an industry when it was formed 300-400 years back, because that is how Warren Buffett explains it. The origins of insurance at Lloyd's Insurance.
Okay, wait. Tell me if I'm correct, because we used to read about, in my law school, any law subject we picked up, we had to understand the history first. So when I had insurance as a law subject, we also were told the history, which date back to 1688, and it started in London at a coffee house which was run by Edward Lloyd.
Yeah, that's the story he's talking about.
Okay, so let me tell you what was the story. Tell me if I'm correct about it. So they said that Edward Lloyd was this coffee house. Of course, there was no Starbucks back then. So all these, his clientele was capitalists, ship owners and merchants. So what they used to do was, apart from sipping coffee, they would also have contracts on what? So now ship voyages that used to take place, they would often have some problems, or the voyage would not be complete, the goods would get destroyed or something like that. So they entered into a contract, or let's call it a wager. So what they were doing was, they were getting into a contract with the ship owner for the ship or the cargo, and if the ship is unable to complete the voyage, they would pay them the amount of the loss that they would face. So the ship owner would also pay them the premium. So this is how that insurance thing started from there. So a lot of people think that Lloyd is the insurance business, but actually Lloyd is not the business. It was the place where all these men met and they started these operations. And later on, eventually, some random, like normal retail investors we can say them, like normal peoples, joined this syndicate of capitalists who were doing insurance so that they could also be a party to the profits that they were earning. And it started with marine insurance, but later on, they started to insure anything that had risk.
Yes, Asta, that is exactly the story that Warren is talking about. So over the years, they moved their operations to a grander place, and they had institutionalized their structures because more and more people were joining the syndicate to insure, to make these kinds of insurances. So these investors always thought that they would always make profits by selling these policies, and the clause of being liable for those insurance claims was only perfunctory for them. However, in 1980, asbestos claims came calling, and suddenly these investors and these insurers realized that they were liable to pay claims for policies that were written 20-30 years back.
Okay, so what is this asbestos and issue around it?
Asbestos is an element that is considered to have carcinogenic elements or the carcinogenic implications. Now, many countries also banned this element in using in various products. By 1960, 70, 80s, during this time, it was clear that there is a rise in complaints against uses of this asbestos, and there are a more number of claims against usage of asbestos and the health hazards that come along with it. Now, the courts in the US are asking the insurer companies or the companies, in whose products the asbestos is found to pay some amount to the users who had health effects. Now, these companies turns to insurance companies, and these insurance companies have turned to reinsurers who have written the reinsurance at the syndicate of Lloyd's.
Exactly. Now, these companies realized that a product that they had sold 30, 40 years back had caused health hazard to some individuals, and now those individuals were calling for claims. Now, of course, 40 years back, they had purchased insurance from whoever, and then that insurer had purchased reinsurance from Lloyd's. So now Lloyd's has become liable to pay for those policies. And suddenly, these retail investors realized that the money that they were making, the profits that they were making by making these insurance investments were also increasing liabilities for them. So now suddenly they were liable for investments that they had made 30, 40 years back.
Right.
Now, it was creating a lot of confusion among these syndicates because it was a lot of people put together. Finally, in 1980s, a few bigger insurance came together and bought out all the policies from Lloyd's, all the asbestos-related policies from Lloyd's, and Equitas became responsible for managing and paying all the asbestos-related claims. Now, this is similar to an asset reconstruction company that we have in India, where your NPAs or bad debts are transferred into a separate company that is solely responsible for professionally managing and structuring and honoring and trying to recover the claims. So similarly, Equitas was trying to honor these claims. Now, this happened in 1980s. Everyone thought that eventually Equitas will fail because these claims are going to be unlimited and their coffers are limited. However, fast forward to 2006, Warren Buffett and Ajit Jain are seeing that this business can be profitable. While there are unlimited losses that could come out of it, Warren and Ajit have seen that there could be some money made out of this. So what they did is they asked Equitas to transfer $7 billion to Berkshire Hathaway, the float that they had. Now, Berkshire Hathaway's float suddenly jacked up by $7 billion. And they said, we will take up Equitas's claims up to $13.9 billion. Almost twice the amount that they were receiving in float.
Wow. Vineet, while you were talking about how Warren took over Equitas, you mentioned another name which was not Charlie, but Ajit Jain. So who is Ajit Jain?
Yes, mentioning his name is long due. He was hired in 1986 by Warren Buffett, and he has since been taking care of the insurance operations. He's rather Warren Buffett's rock star in insurance. So when they started reinsurance business in 1980s, and when they started retrospective insurance in 1990s, and again another crazy insurance bet here, all of this was done under Ajit Jain. He was the fiercest risk taker for Warren Buffett, but also Warren says that we have a very conservative approach because we only take on policies where we understand the risks are justified by the price that we are getting. Right. And Warren, you know, that is a hands-off investor. He does not want to micromanage the CEOs at his subsidiaries. He's not micromanaging, but he's always talking to Ajit Jain. Warren Buffett is personally very interested in their insurance business. So while there are other CEOs who Warren would not talk to for a year, Warren and Ajit talk every night at 10 p.m. and discuss business. No matter where Ajit Jain is on this planet, he will make sure that he coordinates the time at 10 p.m. At Warren's local time. Ajit will speak with him.
Beneath all the stories of acquisitions and investments that Warren Buffett has made has some interesting tale to tell. Along with that, we have investing lessons to learn. So let's go back to the business that already are with Berkshire Hathaway. What is happening in those businesses?
Let's say they are expanding their furniture businesses around this time. RC Willey, which we discussed in the previous episode, is opening another store in Las Vegas, and Nebraska Furniture Mart has finally bitten the bullet to open the second store. So far, they were only in Omaha. Now they're opening their second store in Kansas City. Mind you, this is a 400-acre store that they're building up, where 75 acres is dedicated to parking, and sometimes that would overspill. This kind of a huge operation they had put up in a sparsely populated or in a not so populated area of Kansas City. However, they were selling it so cheap that people from the city would travel all the way to Nebraska Furniture Mart's store and get great discounts.
Remember Rose Blumkin's philosophy? Sell cheap, tell the truth, don't cheat nobody.
Yes, exactly.
Well, that really did work for Nebraska Furniture Mart in Kansas City. Vineet, what is happening with other businesses? Let me ask you directly, what is happening with insurance?
Well, let's talk about General Re, which they had acquired in 1998. We've discussed this in the previous episode. 9/11 happened, so yes, their losses had surpassed $2.5 billion. And this opened up a can of worms for Berkshire Hathaway. Now, every time Warren Buffett is discussing General Re, he is pointing out the 4 principles of running an insurance company. Firstly, you have to be able to identify all the risks that you're assuming. Number 2, the probability of those risks actually materializing. Number 3, you should be able to price those risks correctly. You should be able to justify the price. And number 4, if you're not getting the price you want, you should be willing to walk away from the business. We've seen this that in the 80s, Warren Buffett is saying that their insurance operation witnessed a decline of 85% in revenues. They are saying that if the price is not justified, we are happy to walk away, but we will not take unjustified risks. Warren is saying that after acquiring General Re, he realized that General Re's management was rampant in their risk-taking, that they had ignored the 4th point. They were not walking away from risks. They were taking them at whatever price that came. And this became a disaster for them. Had it not been for Berkshire Hathaway's backing, post 9/11, General Re would have had to shut down. That is the magnitude of losses that they suffered. But that is not all. They also had derivatives. General Re had a large derivative trading division wherein they had more than 23,000 contracts. Warren and Charlie tried to initially sell this business off, the derivative section, but they could not. And it took them more than 5 years to slowly, gradually square off and close these derivative contracts. And for those 5 years, they continued suffering losses. General Re was a loss-making company. From the time that Berkshire Hathaway acquired General Re, it was a loss-making business for them. After they sold off all the derivatives is when they started making profits. And then Warren is saying that General Re is a gem.
Remember, in one of the previous episodes, we talked about a beautiful princess kissing the toad and this toad becoming a handsome prince. I think now it is the Warren Buffett and Berkshire's touch, Midas touch, that is helping the troublemaking companies come out of their hassles.
In fact, similar was the case with Salman Brothers, where Berkshire Hathaway's backing helped them survive. So these were not great businesses that Warren had invested in, but they survived and delivered good returns because Warren had invested in them.
Yeah.
Right.
Now it was managing these derivative trades that Warren has this observation. He's saying that most of the derivative trading volumes are happening between a few large institutions only. So if one institution were to fail, there could be a domino effect. Let's say there are institutions A and B that have a derivative contract. Both have good financial strength. A goes bad on one contract and is unable to pay up, and that in turn impacts B, and then B is unable to pay its own obligations to other vendors or other counterparties. So there's a domino effect. One institution falls, leading to many other institutions taking the hit as well. Another issue here is that a lot of these institutions are hedge fund managers or mutual fund investments who have taken money from gullible retail investors who don't even know the kind of risks that these institutions are assuming.
This also ballooned up over time. Warren also explained this with an example. Say, suppose, imagine all three of us represents or owns all the US stocks or US companies. Asta, you, Vineet, you and me, we all have helpers. Just like in Ramayana, Kaikeyi's maid instigated all the hustle and drama within the family. So my helper comes and tells me, why don't you beat Vineet and Asta by entering into a derivative contract? And I'll be impressed with my helper and I'll reward that helper. Similarly, your helper also does the same thing, and so does your helper. Now, while the helpers are getting profitable, we trying to beat each other are not making any money. Here in the wealth management industry, what Warren Buffett refers to is these helpers are the people who are selling the financial products.
So true, Satya. So these helpers that we have in the family, Warren is referring to them as the brokers, advisors, investment managers, derivative traders, etc., who are claiming to work on our behalf. Now, whether or not we make money, they will make money in the form of fees, performance fees, commissions, etc. So let's say, in continuing your example, let's say the overall wealth, because we traded with each other, reduced, and that went in the form of commissions and fees to these helpers. Now, this is what Warren is saying, that there's a lot of mis-selling that goes on or misleading that goes on in trying to sell or guarantee returns.
This reminds me of the contemporary example in India, which was 81 bonds that Yes Bank was giving, and all these people were selling it to retail investors. But the problem with that was they were mis-selling it. They said that 81 bonds were similar to FDs, but they had equity-like risks, and which that they conveniently did not tell these to people. So when Yes Bank went through the crisis, these bonds where people had invested their money, they had nothing left in them. Which means that as a retail investor, if somebody is approaching to you, which claims to be your helper, you need to do your own research and analysis and understand that whether that instrument is making money for you or not, and what is the underlying asset where the instrument is investing.
True.
And always beware of someone guaranteeing returns.
Right.
Now let's talk about one of their other businesses. Remember, in the first episode, I spoke of one sector that they were invested in, trading stamps.
Yeah.
But you also said that they shut that down.
Well, a confession, they never shut it down. I assumed that they had shut it down because it had become so small and inconsequent to Berkshire's affairs. However, when they acquired Blue Chip Trading Stamps in 1970, it had sales of $126 million. In 2006, it had sales of $25,000, and it still continued to be in Berkshire Hathaway.
But then if it had become such an insignificant business, because now Berkshire Hathaway is invested in such large businesses, why were they still holding on to trading stamps?
Well, Warren does not explain it, but that's a different thing, that they have about 65, 68 businesses by now. And of course, he cannot practically explain each and every business in his letters to the shareholders. He's also saying that if I start giving very detailed information about all of these investments, about all of these businesses, our competitors also get privy to our sensitive information. So he's going to restrain himself from giving in-depth details, but he's also categorizing all of these businesses into 4 different segments. One is insurance, which has Geico, General Re, Berkshire Hathaway Reinsurance, and all of the other smaller state insurance companies put together. The second is regulated utility businesses, which only has Mid-American in it. Because of the size of this investment, it warrants to have a separate sector altogether. Third is financial services, where they had a few leasing operations and also Clayton Homes home loan operations. And lastly, they had the manufacturing, retail and consumer businesses, which included all of Borsheims, Seas, Nebraska Furniture Mart, Scott Fetzer, Feckheimer, and all those businesses. Apart from that, of course, they were also making money through their investments. So that was, let's say, the fifth segment.
Nice. I really like how structured Warren Buffett is in terms of explaining his business or doing that segmentation. And the another thing that I like about him is, and you also mentioned in the agenda, and I thought that, I'll ask you in case you forget, the ratios, the financial concepts that he explains, and especially the fact that the way, the perception, the perspective that he has, or the lens through which he is looking those financial ratios or numbers is very different, and also learning lessons for analysts and retail investors. So what is in store for the financial concept?
Thank you, Asta, for taking that up. He's referring to the segment of manufacturing, retail and consumer businesses. There are more than 50, 60 businesses here, and he's saying that these businesses on average delivered a return on equity of 19%, but for Berkshire Hathaway, the yield was just 9.9%. So there's a difference between their ROE and earnings yield. Satya, why don't we, for the sake of our viewers, explain what ROE and earnings yield are?
Sure. There are two different things. First, ROE, it's a measure of profitability of a company. You take the net profit of the company after taxes and you divided it by the shareholders' equity, right? So if you do that, whatever you get is a return on equity. Say suppose the net profit of a company is 20 rupees and the equity, shareholders' equity is 100 rupees. So what is your return on equity in this case? 20%. Now, this is to analyze a company, how the company is using its equity, is ROE. Now, when it comes to earnings yield or return on investment, this is about how our investment is faring. So, what is the cost for us when we are buying a stock? It is the cost that we pay. The purchase cost is the cost. So, when the company is giving 20 rupees in profit and I bought the stock at 200 rupees. So, now 20 rupees divided by 200 is 10%. So this is the earnings yield. For me, the earnings yield is 10%, but for the company, the return on equity is 20%. Yeah, it's two different things. One, to assess the performance of the company, and the second one, earnings yield, is a metric to assess our investments performance.
So yes, Warren is saying that these businesses, given the book value that they have, they are doing well, but the value that Berkshire Hathaway has paid for them, the price that Berkshire Hathaway has paid for them, is reducing their yield. However, Warren is saying that they will compensate the CEOs of these subsidiaries basis their performance of their own books and not what the yield Berkshire Hathaway earned. He is in fact saying that there are two businesses. One has done well, the other has not done well. The one doing well, the CEO will be compensated well. The other one that has not performed well, its CEO will also not get that kind of money, irrespective of what Berkshire's performance was.
Right.
So in fact, he has expressed very rigorous views about CEO compensation. For example, we have seen in the previous episodes that if a CEO is simply trying to grow the operations by acquiring and trying to claim higher pay, Warren does not like it. You have to prove that you can deliver strong return on equity as well. So given his stature, Warren was a director in the boards of 19 different companies. However, no company would let him be part of their compensation committee because they knew that Warren was not going to let the CEO take a bigger pay. Right. Moreover, there was just one company that did put him in the compensation committee, and over there Warren did try to limit the CEO's pay. However, his vote was vetoed.
You see, what we are discussing right now about CEO compensation is a part of corporate governance. And this is a very important parameter, factor to see when you are analyzing the company for the retail investor as well as for the company itself, which often is ignored by people because it does not seem as important as other factors. So, like what corporate governance is basically, those are those set of rules or duties which the companies have to obey to and do, because all the companies want to achieve that economic success, but that economic success should have balance with the individual, the societal and social goals as well. So it's very important for the retail investors and companies to understand that corporate governance is an important part and as equal important part as other factors while you're analyzing other factors of the company.
Absolutely. Corporate governance is the key factor in analyzing any company. In fact, Warren himself got accused of corporate governance issues. Interesting, right? But see, Warren had a stake in Coke. We all know that. For him, it's an $8 billion investment. Warren is on the boards of Coke, but he was accused that he had a conflict of interest. Why? Warren, through Berkshire Hathaway, also had a subsidiary called Dairy Queen, and this Dairy Queen is getting supplies from Coke. Because of this, people said that Warren Buffett could use his position to give supplies from Coke at a discount to Dairy Queen. So because of this, they're saying that there is a conflict of interest for Warren Buffett. But he says Dairy Queen is a very small investment for me, whereas on the other hand, Coke, he has about $8 billion investment. Right. Even if I am, he says, quote unquote, even if I am a bit rational or having a bit understanding of what arithmetic is, it is very clear that my interest lies with Coke and not Dairy Queen. So why would I do that? After talking about Coke, he also talks about the importance of the board of directors and whether their interests are aligned with the shareholders or not. He says that Berkshire Hathaway's board can be a model, for all the US companies. He mentions 4 points on how their board of directors' interests are aligned with shareholders. First, all the directors hold stake in Berkshire Hathaway. Second, they haven't received these stocks because of the grant or something like that. They themselves own the stock. Third, they are not receiving any significant amount as director sitting fees for being in the boards of the Berkshire Hathaway. Whatever they are receiving for being on the board of the Berkshire Hathaway is just tiny portion of their total income. So they don't have any conflict of interest here. The fourth is that the company doesn't have any liability insurance against the directors. So they are responsible for their own actions. So these are the 4 points that he mentioned. And he also goes ahead and talks about the importance of independent directors and their responsibilities. He always says that self-interest blurs the introspection.
Yes, and he's in fact giving examples to check if an independent director is truly independent. So for example, I am a director at a company and they are paying me $100,000 annually as director sitting fee. Overall, my annual income from other investments or other jobs put together is, let's say, $300,000 for the year. 33% of my annual income is coming from being the director of this company.
Right.
So a lot of my lifestyle is dependent on being a director here. Am I truly independent? Can I truly take decisions for the sake of shareholders, or will I just try to protect my job? Now, how could a director try to protect his job? He's giving another example without naming a company. He's saying there was this company that wanted to be acquired. The management had found a good suitor. So this company had to be acquired by a larger company. The only reason that could not happen is because the board of directors rejected this acquisition. Why did they reject it? Because the board would be dismantled and these board of directors would be out of jobs. So are these directors truly independent?
This reminds me of the fact that whenever we were taught or, told these points that the company needs to have these many numbers of independent director, one of them should be women. But the important aspect as to that independent director has to be independent in terms of decision making, that he does not have to be biased whatever decision he's making. This is never taught to us. And I like how Warren Buffett is using these letters to educate retail investors, analysts, that these are the thought-provoking, lens that you need to look through when you are analyzing the company.
In fact, he's saying that race, age, gender will not be used as filters to install someone on their board, on Berkshire's board. He's saying it had to be merit and their background and their ability to advocate for their shareholders is what would decide whether a director was suitable to be on Berkshire's board or not.
That is very important quality of an independent director. So while this is a qualitative aspects which as retail investors will get to know only by attending a couple of their meetings, independent directors meetings where the whole board is there, there are also some quantitative aspects that we can check by ourselves because there are so many disclosures that the regulations mandate, like sitting fees, etc. Apart from that, regulations themselves mandate that these independent directors shouldn't take more than 10% of their annual income as sitting fees, the director sitting fee, that they shouldn't hold any position in the company, key managerial position in the company, and they shouldn't be related to the promoters. These are some of the facts that are already taken care by the regulations. Apart from that, from whatever the disclosures that the company has made, we can also assess whether a director is independent or not. It's a very nuanced thing, but I think it also helps a lot when we are getting into the corporate governance aspect of analyzing a company.
Which is very, very true. Now that we are entering into our very last segment, so Vineet, what do we have in store for the last segment?
Let's talk about succession planning because, again, Warren has spoken of it at length. We'll talk about two aspects of it. One is how his personal wealth was going to be transferred, and second, who was going to replace him and Charlie when they passed on. So let's begin with talking about his personal wealth. Around this time, Warren was the second richest person on earth. His wealth was roughly $44 billion. And in 2004, his wife passed away, Susan Buffett, his first wife. And so far, Warren had been thinking that Susan Buffett would take care of all their philanthropic efforts. But when she passed away, he had to rethink his philanthropic strategy. So in 2006 or 7, he decided that 85% of his personal wealth was going to go to charities during his own lifetime. Mind you, we have discussed their succession plan in the previous episodes when he was telling that when he would pass away, his wealth be transferred to philanthropic efforts. Now he's saying that this should be done when he is alive, during his lifetime. So roughly $30 billion went to Melinda and Bill Gates Foundation alone. And he also took a board seat in that foundation. So since then, he has been sending larger and larger installments because the wealth has kept growing. So his 44 billion is now in fact more than $100 billion. So 85% of whatever his wealth is, he plans to transfer to this foundation. That is what he's been doing. Now let's talk of his successors at Berkshire Hathaway. He is the CEO of Berkshire Hathaway, his partner Charlie Munger. Both of them do all the things together. However, look at it this way, there are multiple things. One is insurance, the other is investments, and third is managing all the subsidiaries that they have. So Warren is saying that they have identified investment managers to take care of their investments. They have identified a few CEO candidates to take care of the overall operations, and they've also identified they are looking for someone to head the insurance operations now.
We are talking about succession plan very casually, but think about it. One writing about their own death and how the wealth will be distributed. But yeah, it has to be done at that level. Now, he knows that, once with age, their intelligence also decays. He talks about Charlie and him, that how their age, the intellect also may decay with time. When he was talking about Charlie at 82, he still remained very sound. At that point in time, Charlie was 82. Charlie still remained very sound and active, while there are few people at 60 itself, they may not have that level of intellect that, the other average people might have. So the way or the pace at which our intellect decays also varies from one person to another. And he wants his board of directors. He places a lot of trust on his board of directors to tell him on his face when his intellect is coming down.
And having said that, he's saying that Charlie and I are in fine pink of health. We continue to love our jobs and we will be here. We in fact tap dance to work every day.
Yeah. By the way, it's very terrific, and Warren himself says that it is very terrific to write about his succession planning in the letters.
Wow, this has been such an amazing journey. We have come so far, and this episode had a lot many tales to tell. So why don't we quickly summarize and understand what we have learned from our...
Sure, let me begin. Firstly, we discussed their investments, Mid-American Energy and ISCAR, Mid-American being a utility company and ISCAR being a cutting tools company based out of Israel.
For me, the first key takeaway is about asset allocation. Berkshire Hathaway at their large scale, how they decided what their financial goals are and what their priorities are when it comes to money, and they've had an investment policy around it. So asset allocation is very important.
The thing that I like was the story around helpers, that how someone who claims to be your helper in guiding you your financial journey, but you need to be very aware of what they are promising and what they are taking home, while you could actually not be making enough money. So you need to be very careful of where you are investing and how much you will be able to make in times to come.
And we also discussed depreciation of USD and hence Warren taking foreign exchange bets, because It's because if you're investing in an appreciating currency, your returns add up that way with the investment plus your own currency depreciation.
Talking about the returns, we also talked about return on equity and earnings yield. So return on equity is the profitability measure of how a company is delivering profits when compared to its equity. Earnings yield is for an investor on how their investment is faring. So, we look at companies and say that, hey, this company is performing really well when it comes to ROE. But if you go just invest in that company, it also matters at what valuation you're investing. So just because a company is doing well doesn't mean that our investments do well, because it also depends on the valuations at which we invested in the company.
Right. The next thing that I liked is that we finally talked about corporate governance, which is not very widely discussed topic or ignored topic, and how the CEO compensation was a very important aspect of corporate governance, and how Warren Buffett is giving his takes on that the CEO should be being compensated depending upon how he is been doing with his own business, not how others are doing or Berkshire Hathaway is performing as a whole.
And we also discussed the utility business and how utilities are kind of a hedge against inflation, and how Mid-American Energy stood out on two fronts, one being an essential service and two that they had operations in multiple states that would hedge their earnings against each other.
Talking about the corporate governance, I also want to point out about the independence of the directors that Warren is talking about. It's a very nuanced thing. Usually we consider it as a compliance thing and we may not give much importance to it. But these are also few of the things. The corporate governance plays a major role in how the affairs of the company are.
Right. And lastly, the thing that I liked was around succession planning. It is really important. How big or small your profession is, your family is, your business is, you need to have a good succession plan. And I like how Warren Buffett is really well structured for his personal succession plan, and a succession plan is for his Berkshire Hathaway. And the thing that I like the most is that he has structured the Berkshire Hathaway succession plan in a very nice manner, because he understands the business has grown multi-folds and one single person or maybe two individuals can't handle the entire business that they have. And he wants, that specific that individual should be able to do good with one area rather than handling all and messing everything up. So this has been quite an exciting journey for all of us. In the next episode, we are going to talk about 2008 financial crisis is going to happen, and succession planning. Vineet is finally going to reveal who are the successors who are going to take after Warren Buffett and Charlie Munger. So do stay tuned with us for the next episode. Also, do tell us in the comment section what was your favorite story or your learning from this episode. See you. Thank you so much.